Happy Friday, everybody. Welcome back to another edition of Real Assets Weekly. Today's the 12th episode. It is August 11th, 2023. And with me is Jimmy Wang. Jimmy, our man up in Portland. How are you?
I'm doing great, Turtle. Happy Friday. Good to be with you. We're up to a dozen now. So, we're going to get it rolling. Come out at 2Q earnings. There's a lot to talk about. And I hope you're enjoying the end of the summer. We've got some dog days ahead.
Yeah, that's right. That's right. I think so. I think there's a lot of people that are, like you had mentioned before, school teachers going back to school soon. The reality, in more ways than one, maybe we shall see, is really, about to hit people like a strong cup of coffee in the morning. Speaking
Yeah.
of, and I think, we talked about Jimmy. We talked about talking about some REIT stuff, some earnings reports this week that came out. We had a bankruptcy or a going concern announcement filed. And so, a lot of moving parts out there. But before we get into any of that, let's jump off with like we were just rapping about the 10-year bond. Because like we said, like we tweeted, most of the good content here from this week, we can just really look at our Swami Research Twitter stream. And like we tweeted yesterday, a lot of these REITs are actually breaking trend in our Swami ETF model. And so what I mean by that is if you look at this page here, excuse me, this page here. So yesterday, for example, the copper ETF we track, ETN, I believe, House, which is our friends over at Tidal, bunch of housing housing REITs, our friends, not friends, but MPW, the Boys of Medical Properties Trust, and then Res, REZ, which is another. It's got some like mortgage-backed securities, but it's also like a housing-related ETF, and then XLRE, all breaking trend on the same day, while the 10-year is creeping back towards that 4.2 number. Duration investors, it's tough out there.
No doubt. We're going to talk about where we are today versus last fall when the 10-year was back to these levels, when the S&P was about 20% lower, if you can believe that.
Right.
We had the same currency dynamics between US and Japan, if you recall that, that 150 to the dollar, you had all these government interventions. But here we are. I think when we look back at real estate, clearly the interest rate sensitivity factor exposures are back in play. We're coming out broadly from a second quarter where, the fundamentals are okay. They're hanging in there. There's some companies we'll talk about, like WeWork, that are going belly up again. Other companies are steady as usual, but we're at the part now of the cycle where if 2022 was a bit of a washout and it was hard to figure out what was priced in go into the following year, investors are wanting more good news now, right? By the second quarter, if companies are not beating and raising, their year is pretty much locked in. Especially in real estate, you don't get a lot of asymmetrical upside. There's no juiced up earnings, or what have you. So it's like, show me what's next. And what we see next is the 10-year chart and the interest rate chart and the macro picture. We'll have a chance to talk about a bunch of things, but especially I thought it would be interesting now, before we get pulled aside, to mention that yesterday there was a mega merger announced. Tapestry, which my wife previously worked at, is the umbrella company that owns, Coach, Kate Spade, Jimmy Choo, a lot of, houses. It's a kind of a luxury retail house. They're going to acquire Capri Holdings, which owns Michael Kors. I think they own Jimmy Choo.
They own Jimmy Choo.
Tapestry owns Stuart.
Okay.
Yeah, but Tapestry has Stuart Weitzman. So think about the kind of the LMVH concept. You could say, hey, there's some synergies here between the two companies, but consumer discretionary is in a tough spot. There's definitely some heavy work ahead, but any type of read through into the economy for real estate and some of these underlying tenants, it's hard to say that things are getting better, right? I think, and so that's kind of where we're trending backwards again. You see the S&P recently, the XOI. There's a lot of these charts, right? That are starting to top out, I will say. I'm not going to make the call, but there's a bit of
Right.
that going on.
No, definitely. And like we've mentioned before in previous episodes, but these are just key levels. And how much of this is just, you know, like NFL Sunday countdown guys just trying to sell, we're not really just trying to sell matchups. I mean, these are key levels. 145 was where
Yep.
USDJP, or that's where the BOJ or ML, Ministry of Finance in Japan intervened the first time, and then 150, they intervened again, from my understanding. Check out Weston Nakamura on Blockworks for all things USDJPY. But, and then of course, how key that was to where the 10-year topped out last time. And so these really are key levels. And that, and then last thing on this before we get into some earnings stuff, maybe, but I mean, really, it's this 10-year, the 10-year thing is interesting. I think it really is, to me, the real, the real big shoe to drop here is the yield curve. It seems like it's like, okay, so just to really simpleton terms, okay, the 2-year pays 5, the 10-year pays 4.1. The 30 years at about 4.3 right now. Let's check that. 4.25. So like it would just make sense, right? So then the 10-year, higher for longer island, right? Seems like there's a big migration on FinTwit towards higher for longer island. And so that could be the yield curve uninverting, which isn't that where everybody dies in these last 7 yield curves? So like that's one scenario, right? Which is interesting and something to watch and maybe playing out. Although, it looked like the 10-year was hitting some resistance maybe, last week. This week it's coming back up. And then the other scenario is, of course, that this thing stays inverted, and maybe that. So the big question, I had a tweet this week: 10-year hits 3 or 5 first. That's the question. And I guess no person I'm more interested in their opinion than yours. What do you, if you had to guess, where would you think it hits first, 5 or 3? My guess, if it hits 5, it's not going to be for long, and it's going to be like that. You ever seen that movie Ghost Ship, where like I think the movie opens with like a bunch of people on a ship, and then for some reason a wire snaps and like everybody's head gets ripped off. That's kind of what I think would happen if the 10-year hit 5. But I don't have a CFA, so I don't know. What do you think?
I think the market for maybe multiple years now has been really playing this cat and mouse game with Jerome Powell, with Fed hikes, trying to get in front of things, especially larger capital allocators, right? The individual guy, we can speculate, we can talk shit.
Yeah.
But from the institutions, they need to deploy capital. So it's going somewhere. It's either going to equities, it's going to fixed income, or it's going to money markets. And what we've seen is, I think the Fed, I don't know that it's fully on them, but these are kind of slow motion train wrecks. So we had that big inverted yield curve. If you look at I think he had a couple of these 1-week charts, right? With the 10-year, with some of these other things. I mean, what happened 4 weeks ago? Jerome Powell basically said,
Yeah.
fuck what you think,
Yeah.
we're going to hike it. We're going to maybe do another one. And, as soon as you heard that, the short end of the curve continues to go up. And then anyone with a fixed income allocation on the margin, right? Their positions got less and less attractive. And maybe we hit 5 before we hit 3. Certainly my thinking is what's a little precarious. We talked about the complacency in the market. I think we've all been surprised. Oh, fund flows, stock market only goes up. But again, the leading indicators don't look great. China is flagging. The US is going into the slowdown. We've talked about all those different catalysts where the consumer is going to be under a lot of pressure. So I do think that on the margin, even if you don't hit inflation fully, we might be in a period of mild disinflation from a very high level. But I think the net is that as the economy goes deeper and deeper into a slowdown towards the back half of the year, as the stimulus goes away, student loan payments come back. Again, my wife at Nike, right? A lot of their leading indicators, a lot of all these retail guys, they're seeing broad slowdowns across the globe, in e-com, in foot traffic. So this back to school season and going into the holiday season might be a sign of things to come. And I think what would be disastrous was that the market, or people think the economy is actually getting better, because in some ways we're trying to heal. We have a bit of a steepener on the back end. The 10-year starts creeping up to 4.5, 4.6, what have you, and then you start getting some really nasty data around the holidays. And again, whether it can snap and people rush into bonds. I mean, if Powell said, "Hey, I'm not in a hurry to lower rates anytime soon," why would you jump into the 30-year or the 10-year when at the front end of the curve, you're just going to get paid to wait? You're going to collect your 5.5. You're going to collect your 5 3/4. And then what? So what happens to the dynamics of capital flows in that type of scenario? I think, again, we're kind of in this wait and see period for the next couple of months. But I would be hard pressed to say, hey, we're going to grind higher. And again, we're not too far from all-time highs on the S&P, which is incredible. Right. Another 5% lag, 10% lag, and here we are. But by a lot of measures, you pull up the VIX, we've kind of bottomed out a little bit. VIXN, RVX, all correlated to that kind of that recent top we had in the end of the quarter, right? That June, July period.
Of all the great stuff, excellent context. And I think of all the charts, I was just flipping through while Jimmy's talking here. I mean, I think to me, the one that's just the most just vulgar, just like violent. I mean, this is the core, and again, I don't know what you make of this. I don't know what happens. I don't know what you do with this information, but it is just, Jerome has just really wrecked the fixed income investor on a relative basis. What do you do with this? I mean, you have stocks gaming, like you said, stocks gaming this. It's like when a parent is trying to discipline their kid and the kid is just like making a mockery of it. Like that's what we're in right now. The stock market is like, oh yeah, you're gonna ground me, are you? He's that, and then the bond market is like the other kid that's like, oh, okay, dad.
That's perfect. You're right.
Yeah. So I don't know, man. I don't know what to make of it, but that's what's going on there.
I'll add a little corollary, especially as capital allocators, in the financial advisory world, there's a lot of talk about, hey, how much can your money, how hard can it work for you? When we deploy capital, what is your long-term expected return? I mean, there's a paradox, right? When the markets run like that, forward expected returns should decline. But at the same time, we're in an environment where the risk-free rate is now 5.5. And this is not the world is not academics, but when you make a presentation and you have to, keep a straight face, right. If you can get 5.5 risk-free, what are you proposing to the client as far as expected returns for your equity allocation?
Well, based on CAPM.
Based on CAPM, right? If you're going to get 6% is in some ways doesn't look attractive, but we might not get 6%. To say you can get 7% or 8%, all of a sudden we're back in this environment where we're saying, hey, equities are going to get you 8% in the long term. And do you believe it? Because if you don't say that and you can get 5.5% risk-free, are you going to deploy anything to equities, anything to fixed income?
Right.
Like, for that type of volatility profile, right? The risk-adjusted expected return in the market has to be lower than that. But we're in this weird paradox where if you have to deploy capital to outpace inflation, to, think about the long term, we're back, we're dreaming again.
Right. No, that's a really good point. And I think it touches on a topic we should come back to think about this giant world of, advisor-led portfolio decision-making, which is massive. And I think bigger than people even think about. And to your point, the model is, well, depends, charging. Here's the point. The point is that like the model is generally charging a fee on assets under management. If those assets are in cash, that, some places people charge on that, some places they don't, but it really is kind of a weird value proposition to be charging AUM fees on cash products. And so the point is that to Jimmy's point there, it's really an interesting thing to think about, because yeah, I mean, if you came in with a fresh $1 million, and like you said, you can get you can get a guaranteed 5.25 or 5.5. What? Yeah, it's I think it's hitting the tip of something that could be bigger. Like, yeah, like for the first time in a long time, there's a risk-free rate. That's all I'm trying to say.
Yeah.
And that's,
And
yeah, big development.
what I've seen recently that's kind of grown in popularity for some clients now is people getting back into structured notes. So
Yeah.
it's it could be for any duration, right? It could be for 12 months, 3 years, 5 years, but they're saying, hey, let me track the Dow Jones, the S&P, what have you. But I want some type of, again, this type of behavior where you're stretching for yield, you're stretching for return. We know how that kind of ends when you dip away from risk-free to get a little extra versus, it's not as fun to structure something with just 3-month treasuries, right? But it's, I don't know. It's not just Brownian motion. All these charts that we've seen, we're back at this, end of August or end of the summer. Again, you feel the complacency, but there's a couple things are lining up now where I think this kind of back to school fall semester, we're going to have a lot more consequential movement in the market. So
very well said. Let's jump into some consequential moves from last week in the world of REITs. So we pulled up the index already. It looks like crap. Maybe this tweet's from us yesterday was in, maybe it's a little bit of context. So as REIT investors, this, if we're going to call, really Jan 1, 2022 was like a fresh cycle. The market really topped like the day, a couple trading days before. And fresh year, Jerome Hart starts hiking rates a few months later, and the party was over at that point. So using that as our cycle start, REITs are down 23.5. Like Jimmy said, S&P's 5% away from all-time highs. So really remarkable underperformance there. As interest rate, the risk-free rate, back to this chart, a REIT is, they don't love, or back to the stocks versus bonds charts. They clearly don't love rates going higher and higher. So here is where we are here. 1 second here. So let's check out. So tell us about WeWork this week. That was a big earnings report, and we may not be around much longer. So tell us a little bit about that. I'll be right back.
Yeah. I don't know that there's new news to report. This is a company that restructured, right? They were going belly up prior to COVID. And during this pandemic era, they were able to come out as a SPAC at $10 in an interest rate financing environment that was, at rock bottom levels. So, regardless of the way the entity was structured at a corporate level, certainly their asset location, that general portfolio, one could say that there was, sufficient capital market financing or liquidity available. So if you can't make it in 2020, 21 coming out with those terms, you think about the high yield market today, think about the office market, right? All the CMBS that rolls, it's just like the debt market is gone. The SPAC founding shares, and again, in hindsight, some of the ludicrous payments and transfer of wealth from the insiders, right, and the sponsors, getting it dumped back out on retail, going from $10 to 20 cents. Here we are. I think there's a lot of talk about if the company goes belly up, what happens to the leases. something tells me that, again, all these, when you're swimming with the sharks in Manhattan and you get a sizable portfolio, you have a global portfolio, there's a game within the game. You know, the insiders and the people who are in the asset class, they're not going to let the market go to shit. But what's likely going to happen is that if there is more sublease availability back in some of these markets, if WeWork has to restructure their leases and make concessions with a landlord, a lot of that is not publicly reported, right? A lot of these private landlords, these mom and pop shops, were so happy to have a WeWork in the earlier part of the cycle. You know, it attracted tenants, they put in CapEx, it brought buzz to the building, they had, you know, favorable leases. But now it's, you know, are you going to, if you have a WeWork that's still functionally capable and people are coming in and out, whatever that traffic is compared to the peak, we don't know. But are you going to kick them out, and who are you going to lease it to? You know, where are you going to take that space to? So it just, a lot more questions than answers. And for me, this continues that what I think is going to be a multi-year, maybe a half-decade malaise for certain real estate sectors, where just, you know, when the uncertainty goes up, the discount rate goes up, and it's as simple as that.
So for the real estate tourist, like listening to podcasts and stuff, not, you know, not necessarily, you know, in the talking to management teams and stuff, but just listening to REIT and traded real estate podcasts and stuff. Everyone talks about the survive to 25 thing, right? It's like, we got to roll this debt for one. we got 16 months. We got to survive. Is this the first shoot a drop of many of these guys that are not going to survive to 25, or kind of, do you have thoughts there? And yeah, or
I think what's important to know.
Yeah.
Yeah, sure. What's important to know about WeWork versus some of these other real estate plays is that WeWork does not own a lot of its buildings.
Right.
Right. They are an operating company. They have long-term leases. There's a small minority of the portfolio that they have equity ownership stakes in, but the mindset of an operator versus that of a landlord is much, much different. WeWork, right? They have a lot of unsecured debts. They're going to do what they need to do to bring cash flow in. But at the end of the day, if they go belly up, they're putting the space back to the landlord. And so the ultimate cascading effect, right? The effect on the broader market is still somewhat in the hands of the landlord, because the office fundamentals have been, you know, stagnant and not doing well for some time. WeWork doesn't exacerbate that. It's part of that ecosystem, but based on certain liquidity events that may or may not happen, that can create the additional fallout. You know, we've already talked in prior episodes about how there's such little transactions in the market. We don't have a good sense of bid ask. We don't have a good sense of where properties are. I mean, again, just, you know, if you think about where a WeWork location typically is, those buildings are pretty desirable. They're in, you know, good locations, good foot traffic. There's certainly, you know, there's been a few exceptions where they've renovated a Class B building, but most of these are, you know, well-located, functional buildings. So, you know, again, presumably so, but there was a certain price for that, much higher price. And when we talk about comping from Class A to Class B and downwards, you know, when some of these good buildings start trading for 30–40% lower, and the equity is wiped out, or the equity is taking a 75% bath, what does that say about everything else? So it's wild. I'm still surprised that they were able to, you know, recapitalize in that 2021 period and come out as a SPAC.
Yeah.
But as a business model, this was kind of, you know, shooting fish in a barrel. I think people saw this coming.
Yeah. Yeah. And so maybe let's, and I had to pop out. I had to deal with something.
That's right.
So let's do like a 60-second wrap, a bow on the WeWork thing. So, I mean, maybe a little more 60 seconds, but so it was a private company. Then, so all this price history we're seeing, that's after the SPAC IPO. That's correct.
Mhm.
And so
Yeah.
what now? And so, yeah, just take us through like what, so I guess my, here's another question for you, or on the daily, you can see it more. I mean, this thing is up on that news that it is a going concern. Like, how does that, am I missing something? Isn't
Yeah,
that,
it was a
wasn't
couple
there
days ago, right? You
yeah,
imagine there's some short covering at the very bottom there, that first day, right? You had
yeah,
that big panic and the out. And
right.
again, it's functionally speaking, this company has zero equity,
Yeah,
has a ton of debt. Um, again, the genesis of the company, this is a private company that came in during the GFC. They opportunistically swiped in a ton of high quality assets with decent lease terms at very favorable rates. And then they captured a spread by, leasing in bulk, or leasing to the individual person, but, acquiring these assets in bulk to capture the difference in their rent payment. And that carried them for the whole cycle. What I think is also misleading, we talk about skeletons in the closet and digging
yeah,
deeper into their release. You'll see at the very top at the earnings release, their consolidated portfolio occupancy was 72% at the end of the quarter, up 2% year over year from 70% the year before. How misleading is that? When you look at consolidated portfolios, we mentioned their complex ownership structure, their lease structure, but then office buildings. Office buildings are either 90% occupied or 50% occupied. So what's the 72% is a very misleading number for the company, because you have a healthy or decent portion of the portfolio that's functional, that's at 80, 85, 90, trying to tell the story, trying to generate the cash flow in these desirable assets. And then you've got the lease up portfolio. You've got still that bloated extra locations and everything from the prior years. And that's a failure to launch. And that's killing their cash flow. I don't know that there's a great way for them to downsize the company by 50%, basically take massive impairments and dump all that real estate that they're on the hook for, right? The landlords want their money. They're not going to go away without a fight. So things could get messy, right? Again, because WeWork is asset light, the concept will survive, but they're just buried in so much unsecured debt in this type of demand environment, and I don't see a good way out of it. The bondholders are, they're going to take the haircut because the equity already is effectively a zero. So now it's the creditor's turn.
yeah, very well said. Very that fills a lot of gaps in my head. Cool. No, very well said. It seems like, that these, with regards, like you said, WeWork is not a traditional REIT. Is it structured as a REIT? It is structured as a REIT, right?
I don't think it
I don't
is.
know that it is.
Yeah,
You have to look at it, but who cares? But yeah,
yeah, they've been able to game it and say that their tenant income is technically like rental income of sorts, but they don't own their property outright. So I think it's structured as a real estate operating company.
yeah. When you don't have income, who cares how it's taxed?
Yeah, game on.
So game on. So one dumpster fire of a management team to another. Let's hop to another REIT, and I think that's really the point here. And what we're, what's so cool about talking to Jimmy is it seems like there could be a really interesting opportunity here in these real estate investment trusts, if with regards at least to privately held institutional or privately held REITs and privately held real estate in general, commercial, apartments, etc. And, and we've talked about that in previous episodes. Look at those. We've had David Arbach of Armada, who has a fund, PRVT, which is all set up to take advantage of that disconnect. We've had him on twice now. So the point is that we're, I think there is an opportunity there, but what Jimmy can help me do, and hopefully you as well, dear viewer, is, separate the wheat from the chaff. One of these real estate is a good business set up by the tax, the tax codes made real estate a good business. The management teams can be a problem, however, though. And just because real estate is a good business, maybe if you own real estate, doesn't mean that buying secondary shares of a REIT, which can really just be a management a management compensation structure is always a good idea. So on that note, Jimmy can save you a lot of trouble, perhaps. And let's look at somewhere where a lot of people have gotten into a lot of trouble. It seems like a consensus long on seeking alpha. I'm not sure if there's any money changing hands that influences that. I don't know, but I mean, it is a consensus long within seeking alpha community. Medical Properties Trust had earnings this week, and they didn't look good, Jimmy, huh? According to the market.
No, it's what Denny Green says. They are who we thought they were. Did you let them off the hook? I think I think for the institutional investor, they figured this out. Again, just when I think about my time in the real estate space, it's very easy to get cozy with management because these are the same investors you keep going back to for equity capital. These are the same people you go out drinking with at all the conferences, and it's a small space with people with long tenures and long memories. So whether they're friendly with management, whether they've been invested in the stock vis-a-vis benchmark exposure, underweight, overweight, you can be underweight this company, but if you're Cohen & Steers, if you're a CBRE and you own, 20 million shares at least, and to express your view, management's still going to like you. So the institutional guys have figured this one out. And I think, other than getting whipsawed vis-a-vis the benchmark exposure, like maybe a company like SL Green did, right, where it fell so much. And there was that week where BXP was up, XL Green, that when portfolio managers are serially underweight a sector and it starts running up on them, people start freaking out, especially the hedgies, the market neutral hedgies that have to cover that. But this is, in my opinion, becoming one of those retail high yield names, day trading names. The quality of the shareholder base has declined, and that's not to crap on retail, right? But I think the people who are active, who are trading, is look at the volume profile. Even in 2023, retail interest was very, very much benchmark owned, sleepy. People don't know about MPW, but certainly as the volatility profile kicked in, after that January, some of the underlying discrepancies, we've transitioned to a new phase in the company's era. So it becomes much less predictable to see where this is going. And ultimately, it could be a zero, right? It's who's to say the shoe won't drop? But that's to be determined, right? Has the bone thoroughly been picked? This chart would say that a lot of the easy pickings are out of the way, but you just look a little deeper, man. You zoom out a little bit more. You think about the balance sheet, how much debt they've taken on, and what is the underlying value of the equity. We've done all the math, right? We talked, and REIT Rob will tell you, any of the other analysts will tell you, when you peek under the structure with these levered entities that have debt that are at best collecting rent, right? That's one of the challenges of real estate is like it's hard to make real estate not look like real estate when the market wants something different. When tech is blowing up, when people are talking about AI, the best you can talk about in real estate is how you're using computer driven signals for revenue management systems. But when the nature of the leases, when the structure of the leases start becoming impaired and the coverage ratios start deteriorating, there's not a lot of wiggle room. So ultimately, I think this next leg of the story is yet to be told. And it's, as a betting man, I don't see how we get back up to $20. What is the catalyst to get this back to all-time highs, or even to hit $15, $16? And part of my concern for the broader real estate sector, which I think MPW is a bit unique, but there are these canaries in the coal mine, is you mentioned XLRE has been a laggard versus the S&P for quite some time. And then in this last 1 month, 2 months stretch, as Accelerate has broken trend, as the 10-year has, declined, clearly the market is voting with its feet, right? The broader equity basket, we talked about like the Magnificent Seven holding up the entire S&P. Capital has flowed out of real estate again into some of these other sectors that are basically keeping the market propped up. So I don't know that we see that reversion rotation. If interest rates collapse, is that good for real estate? Or would you rather be in S&P? Or would you rather be in tech, right? It seems kind of today, there's kind of this lose-lose bear case, bull case scenario where ultimately, real estate just doesn't look as attractive as some of the other sectors.
Yeah, yeah. The REIT Rob, you mentioned him. We got to mention, anytime, MPW, he's, he now has he now trademarked the ticker. It's his now. He won it in the open market. I think his short was out. He was definitely in the 20s when he came out with his short.
Yep.
And the guy's been
he's in high teens, but this company was floating for a while.
A long time. Yeah, I know exactly. It's been a popular one in the Seeking Alpha community for many years. I remember years ago, I was interested in it. And I think that, he really deserves credit for this call. And it's been an interesting one to watch because it's such a war zone. There's all these anonymous accounts that are so adamant about MPW. I don't know if they're Seeking Alpha guys or their board members or their management team burners or what, but it really has been a very interesting story to watch. And I think this tweet's pretty interesting. I mean, it's really not about the financials anymore. We're looking where the Jets are going, and man, to be a REIT insider, man. I mean, there's no better business than flying around on a jet collecting rent. That sounds like a good life. Maybe we should start a REIT.
That's what people don't leave. People again, there's skeletons in the closet, and everyone is kind of in it.
Yeah.
There's a lot of unwritten rules, and people don't leave. There's just too much. Again, there's mutually assured destruction.
Yeah. Well, to all the longs out there, congrats on your new 15% dividend, and now yous can't leave. I'm out of words for right now for this part of it at least. And Jimmy, it's been a pleasure. Any closing comments? And then if not, let's get to the weekend and we'll talk very soon, man. I always appreciate chatting with you.
No, it's been again another fantastic episode with you. There's this second half of the year. From an intellectual standpoint, I'm licking my chops, and I think everyone's curious what's going to happen, right? Are we going to will a new bull market? Is reality going to come crashing down? Are we going to have any last second amendments to student loans, to interest rates, right? And we're heading back into an election season. The cycle is kind of underway. So when you mix politics with forecasting and the Fed, there's going to be more storytellers than not. It's a bull market for storytellers, but let's be careful with our capital.
That's right. That's very well said. And thanks again to our man Jimmy Wang. We'll talk very soon, and have a great rest of your Friday, guys.
Cheers, man.